We must have a high time frame bias in the first place. If we analyze what happened recently, that might help in knowing with a higher probability of what could happen next. And from a bigger picture perspective, we had this market going up, then pulling back down, and going up again. So it has a price action of an uptrend. On uptrends, we break past highs, and when past highs break to the upside, that's what it's called a bullish break of structure. Now, if we were to follow the theory of trend continuation, after a break of the last high, the market should have pulled back down. The usual final destination or target for this downside pullback should be a demand or support taken from the previous low. The low that's found right before the market formed the break of structure, before it broke above the last high. The theory suggests that this demand or support should give an opportunity for a buying setup, because the market often will bounce up from this demand or support, with the target being above the recently created high, in such a way to continue to create the bullish break of structure. Basically having a similar price action like we had on the last structure, where a similar thing has happened, but as we already can see, the theory of trend continuation did not respect this time. The continuation is mainly based on the market not being able to break below the past low. In the scenario where the pullback ends above the last low, that's a higher low formation, and the uptrend has a higher probability of continuation. But when the market breaks below the last low, that's when things become more complicated for buy-side traders that are holding a bullish bias, which is what happened on this market. When the last low breaks down, of course being a lower low formation, the first lower low that has been formed while the market has been on an uptrend, that's a huge sign we might have reversed into a downtrend. That's why the first break is called a market structure shift. It signals a trend change, and when the low breaks down, that's bearish, as I said, indicative of a downtrend. If you remember, during an uptrend, after we get a break of the past high, a pullback to the downside is expected to happen. Now on downtrends, the same logic applies, just the other way around. On downtrends, the pullback should happen to the upside. The target of the upside pullback is now a supply or resistance. We have one supply on the extreme high. This supply was caused from the downwards impulse that started this bearish momentum, basically with increasingly large bearish candles. Then it pulls to the upside and pushes back down, validating another supply since it has done a similar price action pattern that happened on the extreme high. In this specific case, we can already see that it's from this supply or resistance where the market filled and rejected back down. Basically, the level that respected was the supply from below and not the one from the extreme high. What's best to do in the first place is to just wait and see what level it respects, and of course if it does respect in the first place, because the market could also just break both of these resistances to the upside. So you can try to snipe which level will hold. In that case, you might look to trade every time these resistances or supply levels appear. With a sell short position on the supply, stop loss above it, and take profit below one of the past lows, which it worked out well as we already can see what had happened. What it did is to break below the past low. So if you remember what I said in the beginning, during uptrends we get these breaks of past highs, then after these breaks the market will usually pull back to the downside. The pullback is also called as a retrace. But the key thing to remember is that after a break of the past high, or after a break below the past low, a pullback should often happen. So if we now look at the last price action where we got this impulse to the downside, this impulse broke below the past low, now this time being a bearish break of structure. Now if we apply what I just said, the fact that after such breaks we expect a pullback, in this specific case that means a retracement to the upside, a short-term bullish action, which is exactly what is happening right now on these last few candles. The target of a retracement, while the market is in a downtrend, is on a supply or resistance, that being the last upwards candle before the market started gaining bearish pressure and forming the impulse to the downside, impulse that breaks below the past low. In this case, this is that bullish candle, very clear and simple detail to follow, and this becomes the new supply or resistance, and make sure to cover not only the candle, but the wicks as well. And we can see how close the market came to the supply on this recent pullback, and then it started to reject back down. Now there are two possibilities in what can happen next. In one scenario, this was the top of the retracement, and then the market keeps breaking down the past low. That means that this retracement did not fill the supply before breaking down. If this happens, this supply invalidates since we enter into another bearish structure, and the supply might be the last bullish candle before it started going down, which would be this candle. This would be the new supply or resistance if this happens. And we just repeat the same system step by step until the market finally fills the zone. On the other possibility that could happen is that this downside movement ends and the market continues to push to the upside into filling this supply. Now, there is a more advanced concept that supports this possibility. Very few will notice this, so I'd suggest to pay close attention. If we look at these two candles, the bearish candle that formed the low and the bullish candle that's right after the bearish one, this price action on a lower time frame distributed on multiple candles would look something similar to this, an internal downtrend with lows that keep breaking down. So we have these bearish breaks, but on the lower time frames, that's what this bearish candle would look like. But then after the bearish candle, we see how we have a bullish candle. This candle breaking above the last one, that should look like this on a lower time frame, having a push to the upside that first breaks above the last high. And as you know, when the market is in a downtrend and then we get the first break above the high, that's the trend change or structure shift into an uptrend. The main goal we should be looking for this internal uptrend is to fill the supply from the 4-hour chart and hopefully have a rejection that breaks below the last swing low, since we will be looking for a selling setup from the supply. We first wait and see what happens, and then we react based on what the market is doing. So after that downside pullback, it pushed to the upside again, this time filling the supply with a wick. If we look at where the market bounced, on the left of this bounce, we had an internal demand, a similar thing as I explained on the theory presentation. And this demand filled on the lower time frames, and that's how we got this bounce that entered into the high time frame supply. Now what we can do is to flip into a lower time frame, basically getting into the internal time frame. We do this when the market hits the high time frame supply or resistance. As an example, we entered into the 15 minutes chart. It's the same price, just structured differently, as we can now see the price action in more detail. And that's exactly what we must do. We need to analyze the market structure of this market on the lower time frame. To do that with better accuracy, it's also better to zoom out in price, especially on the last structural movements, which in this case, that should be when the market started this internal uptrend. And the question is, what caused that internal uptrend? Well, we initially had a downtrending price action with lower high formations. Then instead of holding another lower high, it actually pushed to the upside. This breaking above the last high, and the break above the last high during a downtrend is a trend shift into an uptrend, and this happening on a lower time frame, on the internal price action. That's an internal shift into an uptrend. But I keep pointing that this uptrend is on a low time frame, so this might just be a pullback to the upside if we were to look at it from a high time frame perspective. Now we saw on the higher time frame how this short-term uptrend created this demand, and it's exactly on this demand where the market pulls back into, then respects with a bounce to the upside. This bounce managing to break above the last internal high. So that's a break of structure. And since this happened on the lower time frame, on the internal price action, this is an internal break of structure. That's not saying anything complicated besides the fact that the internal uptrend has continued. It continued into filling the high time frame supply. Now, after a break of structure, the market will often retrace back down. So we must keep an eye on the price action the market is forming. For example, in this specific scenario, we constantly had higher lows from each impulse to the upside on this low time frame. But then, on the last impulse, we did form the first lower low. Basically, the market pushed to the downside and broke below the past internal low. So as we had an uptrend before with higher highs and higher low formations, then we had this impulse to the downside, which broke below the past low. The first break of the low during an uptrend is a market structure shift, a trend shift from an uptrend into a downtrend. But keep in mind that we're now talking about the trend shift into a downtrend inside this 15 minutes chart on the internal price action, because the high time frame is already in a downtrend, as we've seen on the 4-hour chart. But on the low time frame, it just started after this break, and we can use the high time frame supply in Confluence with the low time frame reversal. What we would expect from a downtrend on the internal levels is to keep forming lower highs and lower lows, the lower high being our potential entry level for a sell position, and the lower low being a take profit target for the sell position. Now on downtrends, the lower highs usually stop on supply or resistance levels. Our main task now is to identify that specific supply or resistance, which if you know the theory, that shouldn't be hard to do. That's the last bullish candle before the market started the downside impulse. That's around this candle right here, with wicks included, this being the internal supply. From supply levels, as I said before, we look for the next retracement or pullback. That pullback on downtrends is a move to the upside. The point of this upside move is to form the lower high and the lower high needs to end on a supply or resistance. Of course, that's not the case and is not a rule, because many times, and probably most of the times, it will push to the upside, but the lower high could end below the supply. If this happens, your position just doesn't get opened. But that shouldn't be a problem. Most traders see a setup they missed as a lost opportunity where they could have won a setup, but it's more smart to think that if you missed the setup, at least you didn't lose the trade. So best case scenario, you missed the setup, which is better than losing. So let's give it a try. Sell short setup on the supply, stop loss above the internal supply from this lower time frame, so right above this level. And for the take profit, the simplest first target would be around the last low. Could be right above it if you're scared that the market might drop down, but then continue to the upside, or if you're slightly more confident below the last low, this will increase the winning ratio by a bit. You can choose whatever you like. And now we just wait to see if the market even fills the supply in the first place, because if it doesn't, then we move on with the analysis and we need to identify another supply. But that's not the case in this situation, since we got this aggressive candle that hit the supply, opening the sell position, and on the exact next candle, we see the rejection to the downside. After that bearish rejection, the market kept holding downside pressure and eventually closing on the take profit. Now for most traders, this is when they should leave the charts and come back on another day, so they don't give the profits back. Some of the more advanced and experienced traders could continue analyzing the market to know what happened recently and where the market is probably heading. This can be useful when they come back, or you might even find another setup opportunity. One simple thing to notice is that we kept holding these lower low formations. That just means that we're starting to break more and more of the previous lows. These previous lows can be take profit targets of sell short bias traders, and the market is currently at this exact point on the last candle, breaking below this level. Now usually after breaks of the last lows, the market will often pull back to the upside, just like it happened here for example, where the market broke below, and then soon after the break we got an upside pullback. That's what often happens and can be applied on the last price action as well. That would mean that we should get some kind of upside pressure. But this movement should still be holding lower highs, else the downtrend invalidates on the lower time frame. If we trade with the trend, then we should be expecting a similar swing formation as we had recently. So pretty much lower highs with lower lows. And as we already know from this video and from the previous ones as well, these lower highs reject back down from a supply or resistance. So we already had this supply from above, which has worked out well. Now we look for the next one. The next should be around this level, and let's explain why that might be the case. We got a pullback to the upside and impulse to the downside. The impulse breaking down the last low. When the low breaks, that validates the supply. The supply being the last bullish candle before the bearish impulse. That's the theory behind this supply. And what supports this bearish trend even more is the fact that this new internal supply is inside the high time frame supply, same as the last one, which was also inside the high time frame supply. A similar pattern could happen, so we can try it out with another sell short setup. Stop loss above the supply, and take profit can be placed below the most recent low. Or another option could be to zoom out so we can see more of the candles from the left when the market was following an internal uptrend. And we target one of the lows from that previous uptrend. Just like the market broke down this level, it might also look to target even lower than that, especially that the price action is very bearish. So we might look to target this low, the one from below, or the next one, until we have a decent risk-reward ratio. Then we just need some patience and let the market do its thing. The position opens. Then it quickly follows with bearish pressure getting very close to the take profit. So close. And now it's starting to bounce to the upside, getting again into the entry. This looks to be more complicated than the last one. It's why I say that probably leaving the charts after a winning setup and coming back another day might be a better idea. Now it's approaching the take profit once again. Maybe this time we get it. And yes, it closes on the take profit. Now if we switch back on the high time frame, we see how the high time frame supply respected as well, since the market filled this supply, then rejected back down, and the rejection pushing below the past low, breaking it and forming another bearish break of structure. Now again, the same story and same process. After a bearish break, we should be expecting some kind of retracement to the upside. This retracement should end on a lower high. That lower high often ends on a supply or resistance, so we need to identify a new supply on this high time frame. It can be this one, for example, since it's the next bullish candle before the other impulse to the downside. Or it might also be the one from the highest level. We can't know for certain, so we just wait and see what happens, and we only take action when things are more clear. So far, it's pulling to the upside, and the first supply fills, then it rejects down, so it might be a good possibility that the valid supply is the lower one, the one from below. Now when coming back a couple days later, we see how that supply did validate, and the market broke below the past low, forming the bearish break. Now again, after a bearish break, what you would want is to wait for a retracement, identify a supply or resistance, and apply the time frame theory, if you want to set up from the low time frames, or directly looking for a setup down from this high time frame supply. Take your time to replay the video to make sure you understand each and every concept, and I highly encourage to take a look at the link in the description, where we cover step by step everything that needs to be well understood to properly analyze the market.